Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. With US markets closed overnight for the Juneteenth federal holiday, I thought it would be a good time to find out what's in store for the world's largest economy. Betashares chief economist David Bassanese is predicting a US recession within the next 12 months. So what does that mean for markets and what does it mean for Australia too? Remember, we're not an investment podcast and you should seek professional advice before making investment decisions. David, welcome back to Fear and Greed.
Good to be with you, Sean.
So, how likely is a US recession and why?
Yeah, well, look, I've ummed and ahed for a little while, but I've basically bit the bullet and think, it is more likely than not. I mean, I think it's, obviously greater than a 50% probability is why I'm now calling it. But I mean, probably, there's still a chance that the US can avoid recession, but basically, what we're facing is a pretty intractable inflation problem at the moment. Yes, there are some supply side shocks that's pushed up US inflation, but it's also just the sheer strength of demand. And the only way to, tackle that is to get demand down. And it's very hard to fine tune a slowdown. And I think given the aggressiveness of the rate rises that we've seen and that we are likely to see, the US is going to buckle and probably go into recession. So, yeah, that's sort of what's led me to form that view.
It seems to me over the last 6 months or maybe 12 months, David, that in the US, as in other economies, inflation has gone from a transitory supply side issue to not fully a demand side issue, but certainly there's a big chunk of demand in that as well as supply.
That's right. I mean, people say, it's all supply side issues. I mean, there's two, it takes two to tango, as they say. I mean, high prices are because demand is pushing up against supply. And if you look at even like the oil market, I mean, yes, Russian oil has come offline, but oil prices were rising before Russia invaded the Ukraine. And it's because the strength of demand. You're getting a reopening in Europe, you're getting a reopening in the United States. So people are wanting to drive and travel more. So underlying demand for energy has certainly picked up. The fiscal stimulus in the US, which was just incredible, it was the largest stimulus by any other developed economy, and they're paying for it because consumer spending went through the roof. So I think going back to, this time last year when inflation first picked up, we did sort of suggest it was because supply bottlenecks, but ultimately those supply bottlenecks, particularly in the US, it wasn't that supply had necessarily contracted. It was just that the pickup in US demand was so strong relative to the supply process that, the supply chains couldn't keep up. And that's been the reality since.
You've always been a great believer in the US. I remember one of the first Fear and Greed interviews I did with anyone was you, David. And at the time, this is a couple of years ago, I suppose, we were talking about how weak the US economy would be. And I remember at the time you said, don't ever underestimate the US economy. You're a true believer in its resilience. And in a sense, that has shown through, but it's kind of causing the problems now.
That's right. I mean, and the US will bounce back again. Yeah, it's the most competitive, most dynamic economy in the world. So it will bounce back from this, but it just basically the economy needs to slow down because, and also, these things are happening at a time when the unemployment rate is sub 4%. Wages growth in the US is running at very strong levels. So the big concern with the Fed is that unless they slow down the economy now, then even if you think some of this pricing pressure is temporary, the longer it hangs around, the more likely it can feed into wages and sort of get a wage price spiral sort of developing. So that's what central banks are really focused on now. It's not letting even if you believe it is transitory, but hanging around for a while, feeding through into a sort of a more enduring process. And so, short run now, I'm, pessimistic on the US economy, but longer run, remain quite optimistic and certainly optimistic compared to Europe, compared to Japan, compared to China. I mean, the demographics, the productivity outlook for the US still looks very, very good compared to all the other major regions in the world.
Stay with me, David. We'll be back in a minute. My guest this morning is David Bassanese, chief economist at Betashares. Now, I read somewhere recently something that you'd written and you were talking about the Fed being determined to learn the lessons of history and not let high inflation become embedded as it did in the 1970s. And at the end of that, we ended up with a big recession in the early 80s. Am I right in saying that? In the US? Yep. You think that Jerome Powell is determined not to repeat history?
Well, based on what he's been saying, that does seem to be the case. He's quoted Volcker a number of times, and in fact,
Volcker, of course, being the central bank boss back in the early 80s.
yeah, so quick history lesson here was Paul Volcker was the Fed chair, had Powell's job back in the late 70s, early 80s. And after a decade or so of high entrenched inflation, he basically said, enough's enough, jacked up rates. He caused like 2 recessions in a row effectively and basically broke the back of inflation expectations. So that was the price the US paid to finally break the back of that inflation cycle. So the Powell's basically saying, we don't want to let that take root again. And so we'd rather, and he's still saying he can avoid a recession. But I think, if it needs a recession, I think, what he's saying is that he's prepared to let the economy go into a recession if that's what it takes to get inflation under control. And just going back to my view, that basically my view has shifted because of Powell's determination, his at least express comments that, if push comes to shove and the US needs a recession to get inflation under control, I'm prepared to let that happen. And I've basically concluded that they probably do need that to happen for it to get under control.
What's it mean for investors? What's it mean for Wall Street?
Well, look, so the US market up until recently was down around about 20%. It's a bit more than the 20% now. So the S&P 500, obviously the NASDAQ is off a lot more. It's off about 30%. But historically speaking, the average decline in the share market during a US recession is about 35%. COVID was 35. The previous 2 recessions was a bit bigger, around about 50. So just historically, it suggests a 20% correction is probably not enough. So I think there's more downside to come. One clear area where there's vulnerability is on the earnings outlook. So US earnings expectations are still, I think, overly strong given the economic outlook. And in terms of Australia, I mean, as the old saying goes, when the US sneezes, we catch cold. So our market's basically starting to catch up with the correction that we've seen in global markets. We've sort of outperformed for a while, but I think the aggressiveness of RBA rate rises, the potential implications of a slowdown in the global economy and what that does eventually mean to commodity prices, I think is starting to sort of filter through to the Australian market as well. So unfortunately, I probably see a bit more downside in our market as well over the next few months.
Does Australia have to go into a recession?
I don't think it does need to go into recession. And one thing I'm still comforted by is wages growth in Australia, at least as officially reported, is still quite benign. We got a wage cost index number only a few weeks ago that had annual growth at 2.4. In the US, it's running at closer to 5. Now, the RBA talks about anecdotal reports of wage inflation picking up and, them being worried about that. But, so far, the facts on the ground, is that wages growth remains quite benign. So provided that's the case, I think we don't need to go into recession. We can probably tolerate the unemployment rate holding around current levels. The other thing that's going to be supportive of us is that we are starting to reopen our borders. So we're going to get some, foreign workers coming back in. That I think that should help relieve some of the labour shortage pressures that we've got here, which again, it's a safety valve that the US has, but not to the same extent that we have.
So does that mean that the Reserve Bank probably won't lift interest rates as high and as hard as the US Fed?
Yeah, look, I think that both the Fed and the RBA won't raise rates as much as the markets currently expect. I mean, the issue at the moment is that the markets have been focused on inflation and they've been focused on very aggressive interest rate increases by central banks. And so far, at least, there's been no real signs of weakness in economic growth in both Australia or the US. So markets have been able to price in like very extreme policy tightening with impunity because there's been no signs of slowing yet. I suspect as soon as we do start to see the signs of a slowdown emerging, markets will start to reassess the aggressive rate rises that they've got priced in. Now, would you believe, Sean, that the markets actually think the RBA will tighten by more than the Fed over the next 12 months? So, a cash rate of over 4% in Australia. They think the Fed and the RBA will raise rates to at least 4, and the RBA will go a bit more than 4, like 4.5, which I think our economy would be well and truly in recession before the RBA got anywhere near 4%. So I can't see that happening, nor can I see it happening in the US, but that's where we are at the moment.
It does mean there are opportunities for investors, though, potentially even in the bond market. I mean, no one seems to like bonds, but if there's mispricing there must be opportunities.
I've questioned the degree to which markets have priced in tightening for a while. So I thought the markets have been reasonable value even a month or so ago. But you know what? The markets then went and priced in even more. So at the moment, it looks like, so-called catching a falling knife to sort of buy bonds at the moment because they've just been so weak. But unless you think the RBA is going to raise rates to 4.5%, you're looking at 10-year bond yields in Australia at over 4%, 3-year bond yields well over 3.5%. These are, I think, in a year's time are going to look like pretty attractive levels. So, yeah, I'm prepared to say the bond market at the moment is looking attractive for the first time in a long time. Yeah. You can actually get reasonable income from fixed rate bonds.
David, thank you for talking to Fear and Greed.
Good to be with you, Sean.
That was Betashares Chief Economist, David Bassanese. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.